Sorry.
Hello. Today we'll be going over our portfolio construction and efficient frontier. Some of the items that we'll be covering will be our group's risk tolerance score, philosophy, world implications such as COVID-19 and Ukraine war, our chosen sectors, stocks, describe the process of our construction, efficient frontier, explain our portfolio risk level and expected return from the efficient frontier, and lastly, we'll explain our risk-free asset versus the efficient portfolio risk. Our average risk tolerance score is 28.28, which puts us in an average moderate risk tolerance. Based on our risk tolerance score, here's a philosophy that we felt suited for our investment portfolio. First off, diversification. We want to reduce overall portfolio risk and be able to diversify our holdings across multiple assets and sectors, meaning that the weight of any single stock should not be too high to maintain diversification benefits.
With a risk tolerance score of 28.28, it implies a willingness to embrace moderate risk for the potential of meaningful returns over time, adopting a long-term investment horizon, allowing our portfolio to weather short-term market fluctuations. With it, patience is a virtue in the realm of prudent growth investing.
Next, we have a balanced approach. Creating a balanced portfolio, such as investing in both conservative sectors, such as healthcare, and a more volatile one like energy, which suggests a more balanced approach, aligns with our group's average of 28.28.
Lastly, using the conservative approach, guided by a risk tolerance score of 28.28, underscores a pragmatic approach to valuation across various domains with a moderate risk appetite. The conservative approach becomes a dependable tool, particularly in scenarios where market dynamics may not fully reflect true value.
So COVID-19 impacted the world tremendously. It really left a mark in history. A few key things that COVID did do was a low income consumers were hit the hardest. A lot of consumers had to dig into their savings. Also, online grocery shopping increased, and people were really keen to go back to stores. And a lot of people did find interest in health and wellness. But as far as real estate goes, pre-COVID, in 2019, housing was really affordable. Incomes were rising, and the average mortgage rate in 2019 was 3.94%. Going into COVID and out of COVID, residential market was affected tremendously. In April and May, the housing sales dropped to the lowest level since 2007. And as far as commercial real estate, office retail really got affected in a negative way, and still to this day, office is having trouble to recover because in Florida.
The implications of the Ukraine war had a huge effect on energy, real estate, and healthcare sectors. There ultimately was an increase in geopolitical tensions between countries. Energy prices skyrocketed, reaching 20% for 5 months straight. The rise in energy bills led to a higher cost of living that affects and puts the strain on many households. The real estate market has been affected with rising mortgage rates, high housing prices, and not a lot of inventory. There is less competition with Russian buyers in the market, ultimately leading to a higher housing prices. With the high energy prices, this can also affect real estate buyers, developers, and construction companies who will most likely have to increase their prices due to that factor. Health threats are a huge factor when looking at war. With the displacement and movement of so many people, the spread of diseases can increase, causing a threat to different countries.
Okay, And here are some of the economic sectors that we selected for our portfolio. First off, we have energy. Energy is a fundamental human need that's needed for daily lives. This demand is expected to grow steadily in the coming decades, driven by population expansion, economic development, and urbanization. This continued need provides stability and a certain baseline for sector's performance. Next, we have real estate. Real estate is a tangible asset. Unlike stocks, you're investing in brick and mortars and providing a sense of security and stability. It has a potential for income, such as rental properties, to help generate regular cash flow and offering a passive income stream. It comes with the advantages of appreciation, meaning over time, property values can increase, leading to capital gains when you sell. And lastly, you have diversification. It adds a different asset class to your portfolio, reducing dependence on solely stocks or bonds. Lastly, we selected healthcare. With healthcare, it's a resilient demand. Healthcare is a non-cycle industry in which people get sick no matter the economic climate, ensuring a consistent need for medical services such as drugs and equipment. It is supported by the government. Governments worldwide are increasingly prioritizing healthcare, investing in things such as infrastructure, research, and even providing subsidies. Overall, the healthcare sector presents a compelling mix of defensive growth, diversification potential, and long-term appeal.
As for the first economic sector, it's energy. And the two companies we chose are gas companies. So that would be Exxon and Chevron Corp. Exxon has a high dividend yield of 3.14%. And the most recent fourth quarter dividend is 0.95 as of November 14th, 2023. The low valuation with the price to earnings ratio is 8.57. And as for the investments, it's in capital expenditures. And the capital expenditures would be funds used by the company to acquire, maintain, or improve physical assets. And that could be drilling and completing a well, facility electricity, and water hauling. As for Chevron, the high dividend yield would be 4.17%, and the most recent fourth quarter dividend is 1.51 as of November 16th, and the low valuation with the price to earnings ratio of 10.71. And Chevron's main investment is technologies, and that would have potential to add efficiencies to Chevron's core business in the areas of operational enhancement, digitalization, and lower carbon operations.
For Realty Income Corp, this stock has a return on equity rate of 2.8%. The return on equity shows investors if they're getting a good return on their money, and a company can evaluate how efficiently they're utilizing the firm's equity. The net margins are 22.6%. The net profit margins help investors see if a company's management is making enough profit from its sales and if operating costs and overhead costs are under control. The dividend yield is 5.59%. A good dividend yield is between 2% and 6%. So 5.59 is in the range. And dividend yields are good to look at because it tells you what the annual return on investment would be at for the price that you paid for the security. Even though the stock is down 15% due to the high interest rates, Realty Income Corp is thriving under these conditions. It hasn't missed a monthly dividend payout in the past 8 years, it also continues to raise its dividends despite the circumstances, increasing it for the past 104 quarters. The operating cash flow is 2.7 million. Looking at cash flows can help evaluate whether a company has enough cash to pay its expenses and shows its financial health.
Okay, so with CoStar, a platform offering a diverse array of assets and investment opportunities, by spreading our risk across various sectors and industries, CoStar ensures a more stable foundation for our moderate risk portfolio with an earnings growth rate of 12%. This diversification strategy effectively mitigates the impact of volatility in any single market. CoStar's track record and reinforces its reliability with an annual cash flow of 0.479 billion, showcasing consistent performance and solid returns. This proven stability is vital for a moderate risk portfolio, instilling confidence as we navigate the ever-changing landscape of market fluctuations. With CoStar, we can confidently pursue our investment goals, knowing that resilience is built into every facet of our diversified and carefully managed portfolio.
We'll be going over healthcare stocks. We chose Pfizer for being a large cap pharmaceutical stock seeking high growth based on its value and performance. The market capital is 165.327 billion. That's as of today, December 4th, 2023. The 10-year return is 3.51%. with dividends being reinvested into stock, and total returns during this period has been 41.24%. Pfizer is known to be a blue chip stock with defensive and recession resistant traits. This is definitely a good pick for a high growth potential stock.
Perfect. And so the Fidelity Select Healthcare Services portfolio is a mutual fund that's offered by Fidelity Investments. And this mutual fund focuses on achieving capital appreciation by primarily investing into common stocks of companies that engage in areas such as healthcare facilities, healthcare plans, and other healthcare related service industries. With a current net asset value of $130.62, the fund has assets that total about $1.55 billion invested into 30 different holdings, with some of the top holdings being a United Healthcare Group, CVS Health Corp, and the Cigna Group. And the reason why we chose this mutual fund was to give our portfolio some more exposure to the various subsectors within the healthcare sector. That would be like hospitals, clinics, managed care companies, healthcare tech and equipment, and so on and so forth. And also because of the fact that the fund itself does have low fees and expenses combined with a moderate risk and a return of 12.85% within the past 10 years. So considering these figures, we found that it would be a great choice for a stable long-term investment with a risk that we're pretty comfortable with for our portfolio.
Vanguard Total Bond Market would be a perfect bond for any portfolio, given that it has very low volatility. And the reason being is because they seek to track the investment performance of a bond, market weighted, and it's through taxable investment grade, meaning that there's no bond rated lower than BBB on this specific one. And the reason why this would be so great too is because it's appropriate for diversifying the risk of portfolios, because they have over 10,000 individual bonds within the fund, and they all have different maturity rates. And the benefit of that is that this bond mitigates interest rates from that. So you don't really have to worry about pulling out at a certain time or before the maturity date. And 2/3 of the portfolio is invested in U.S. government bonds with a rating over BBB. And it has a 5-year return of 8.34%. And the expense ratio is really low at 0.03%. And before you need a minimal investment of $3,000, but now it's only $1.
Perfect. So now we'll be talking about how we use Portfolio Visualizer to basically see how we can optimize our portfolio. And the way that we did this is we decided to use tickers on a month-to-month basis, starting in January of 1985 and going through till November of 2023. We chose to have an optimization goal of mean variance, so a maximized return. And you'll kind of be able to see how in the next figures that was highlighted. And then we chose an annual volatility of 31.5 because it felt like a comfortable range where it still allows a lot of movement and growth, but not too much to where it would throw us overboard. And then in the next slide, you'll be able to see our different constraints and such. Go ahead and go to the next slide. Perfect. So you can see here that we chose our 5 stocks, 1 mutual fund, and 1 bond. And basically, the way that we did our allocation is pretty much we put our most to put it in a different term, we put all of our marbles and most of our marbles into the baskets that have the highest expected return and the lowest risk. So the way that we calculated our minimum weight and our maximum weight was based off of risk. So you can see one of our highest weighted ones would be our mutual fund. This is just because they had pretty low risk and it was a really great long-term choice. Same thing with like Chevron and Exxon. You can see that they're pretty high up there when it comes to weight-wise. We're pretty comfortable with putting a good portion of our portfolio into these stocks because they have a great expected return, and risk-wise, we were pretty comfortable with that. So that's how we decided to allocate our stocks and funds. And then you can see here our portfolio that we had provided with the numbers that we inputted got pretty close to our maximum returns, so we were pretty on point there. You'll notice that obviously, kind of like in the previous figures, we've got Exxon and Chevron taking up a bulk of the sort of graph here. And then we go into our Pfizer and our mutual fund as well. That way we can have a pretty good return without risking too much of our portfolio.
We on this slide here, we're going to be diving into our portfolio summary, and we're observing a strategic blend of securities across diverse industries. Our selection includes known names and dependable investments like Johnson & Johnson and CVS in the healthcare arena. Pfizer standing firm in the biopharmaceutical space alongside energy points giants like ExxonMobil and Chevron. In the portfolio summary, you also see Realty Income Corp as a real estate dimension, providing us with a steady dividend stream, alongside with Fidelity Select Healthcare Services, offering us a focused exposure to healthcare services, a sector known for reliance and growth. This careful curation aligns with our group's moderate risk appetite, aiming for stable returns and capital growth. Next slide, please. And here we'll be looking at our efficient frontier graph. This here is the efficient T-frontier assets. Our portfolio is structured to navigate the delicate balance between risk and return. We're focusing on the concept crucial to modern portfolio theory. This curve represents the set of optimal portfolios that offer the highest expected return for a given level of risk based on historical data. Our current portfolio's position, as you can see, is prudently placed just below the maximum return at 13.5%, and that's the volatility point. This strategic location was chosen to align with our average risk score of 28.28, ensuring we are not excessively exposed to risk while still positioned to capture solid returns. Next slide, please. Moving on to the efficient frontier transition map. So this colorful visualization is key to understanding the dynamic nature of our asset allocations. Each color band corresponds to a different asset in our portfolio. Each one illustrates their allocation changes across various risk levels. Now, for example, the blue band representing XOM, ExxonMobil, and the purple band representing CVX, Chevron, shows our exposure to the energy sector. The transition map guides us into asset relocations to either increase our potential return or decrease our risk, depending on market conditions and our evolving investment strategy. It's a testament to the fluidity and responsiveness of our asset management approach. And that is it.